Welcome back to the Finance Virtuoso. In today's video, we're diving into one of the great debates in personal finance: leasing versus buying a car. With a car being one of the most significant expenses for many, it's crucial to understand the financial implications of these decisions. Thus, let's get into the nitty-gritty of leasing versus buying. This is the Finance Virtuoso channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to hit the subscribe button and click the notification bell right now. Leasing a car. The basics. Leasing a car, in essence, is like renting it for a specific period, usually 3 to 4 years, in exchange for regular payments. It's comparable to renting an apartment instead of buying a house. Unlike purchasing a car through a loan, when you lease, you never actually own the vehicle. Once the lease term ends, you return the car and, if you choose, sign a new lease for a different vehicle. While purchasing a car through a loan makes the car an asset after the final payment, leasing means you continuously have access to newer models but never own them outright. Let's explore some benefits often associated with leasing. Number 1. Lower monthly payments. Monthly lease payments are generally lower than car loan payments, making it attractive for those looking to manage their monthly budgets effectively. Number 2. No resale worries. At the end of the lease, you can simply return the car to the dealership without the hassle of selling it. You then have the option to sign a new lease or explore other car buying strategies. Number 3. Warranty coverage. Leases often last 3 to 4 years, aligning with typical car warranties. This means the car remains under warranty throughout the lease term, providing a predictable cost of ownership. Number 4. Lower initial costs. Leases typically require a smaller down payment compared to purchasing a car, making it accessible for those with limited upfront funds. Number 5. Access to latest technology. Leasing allows you to drive vehicles with the latest technology, as you upgrade every few years when signing a new lease. Number 6. Potential tax savings. Leasing a vehicle may offer tax benefits depending on your location. It's best to consult with a tax professional to understand specific implications. While leasing has its advantages, it comes with its set of rules and restrictions. Number 1. Mileage restrictions. Leases often impose mileage restrictions, and exceeding these limits can result in hefty excess mileage fees. Number 2. Wear and tear fees. Leases are responsible for returning the car in its original condition, and excessive wear and tear may incur additional charges. Number 3. Credit requirements. Leasing companies typically demand excellent credit scores from lessees, limiting accessibility for those with less than stellar credit. Number 4. Additional costs. Fees such as acquisition fees, registration fees, and potential down payment taxes can add to the overall cost of leasing. Number 5. No equity. Unlike purchasing a car, leasing doesn't build equity. When you return the leased vehicle, you don't have any equity to use as a down payment on your next vehicle. Number 6. Early trade-in fees. Some leases impose penalties for early trade-ins, limiting flexibility for those considering switching vehicles before the lease term concludes. Buying a car. The basics. On the flip side, buying a car involves taking out a loan and making monthly payments until you own the vehicle outright. While the monthly costs might be higher compared to leasing, buyers enjoy certain advantages. Number 1. No monthly payments after loan repayment. Once the loan is paid off, you have no more monthly payments, giving you a period without the financial burden of car payments. Number 2. No mileage restrictions or wear and tear fees. Buyers are free from the constraints imposed by leases, such as mileage restrictions and wear and tear fees. Number 3. Credit flexibility. While a good credit score helps secure favorable loan terms, it's generally easier to obtain a car loan than to qualify for a lease. Number 4. Potential resale value. When you buy a car, you have the opportunity for resale value at the end of its life cycle, which can be used as a down payment on your next vehicle. To compare the total cost of ownership of leasing versus buying a car, we need to consider several factors such as the purchase price or capitalized cost of the car, the interest rate or manufacturer of the loan or lease, the monthly payment amount and duration, the down payment or security deposit, the residual value or trade-in value of the car, the maintenance, repair and insurance costs, the taxes, and fees. Let's use some hypothetical examples to illustrate how these factors affect the total cost of ownership. Suppose you're interested in a car that has a purchase price of $30,000 and a residual value of $15,000 after 3 years. You have two options: buy or lease. Option 1, lease. If you lease the car, you will pay a monthly payment of $300 for 36 months, based on a money factor of 0.00125 and a capitalized cost of $27,000 after a $3,000 down payment. You'll also pay a security deposit of $300, an acquisition fee of $600, and a disposition fee of $300 at the end of the lease. Assuming a tax rate of 10%, your total lease cost would be $13,260. Option 2, buy. If you buy the car, you'll pay a monthly payment of $500 for 60 months based on an interest rate of 5% and a loan amount of $27,000 after a $3,000 down payment. You will also pay a registration fee of $300 and a title fee of $100. Assuming a tax rate of 10%, your total purchase cost would be $33,700. However, this is not the final cost of ownership, as you will have to account for the maintenance, repair, and insurance cost, as well as the resale value of the car. Let's assume that the maintenance and repair costs are $500 per year for the first 3 years and $1,000 per year for the next 2 years. Let's also assume that the insurance costs are $1,200 per year for the first 3 years and $1,500 per year for the next 2 years. Finally, let's assume that you can sell the car for $15,000 after 5 years. Your total cost of ownership will be $38,300. As you can see, the total cost of ownership of buying the car is significantly higher than leasing the car, even after accounting for the resale value. However, this does not mean that leasing is always the better option, as there are other factors to consider, such as your driving habits, personal preferences, and financial goals. For example, if you drive more than the mileage limit of the lease, you will incur excess mileage fees, which will increase your lease costs. Alternatively, if you plan to keep the car for longer than 5 years, you will save money by buying the car, as you will not have to pay for another lease or loan. In conclusion, the decision to lease a car or buy a car depends on individual preferences, financial situations, and priorities. Whether you favor one over the other, it's crucial to weigh the benefits and downsides based on your unique circumstances. As always, my goal is to equip you with the information you need to make informed financial decisions. Have you made a decision yet? Let me know in the comments. And before you go make that lease or purchase, don't forget to subscribe, hit the like button, and share this video with your finance virtuoso friends if you found it helpful. Until next time.